Hello, everybody. It's Hammer J. Helmer here with your weekly rate forecast, joined by a new guest this week. Today's guest is Clyde Penton. Clyde, if you don't mind, do me a favor. Go ahead and just take a minute, tell everybody a little bit about yourself.
Hey, good morning, everyone, or good afternoon, I guess it is here officially on the East Coast. Clyde Penton is my name. Been in the mortgage industry for a little over 15 years and mostly purchase focused and based here in Monroe, Georgia, or just outside of Atlanta in Georgia. So, yeah, that's just a little bit about me. Been in the industry for a little over 15 years, have a wife and daughters. So I'm surrounded on all sides. Um, definitely been an interesting change of face to raising daughters to this point and seeing that side of the coin, if you will, because my sisters were all older than I am, so I didn't really get to be around for the growing process with them as much, or at least not in my memory. But yeah, that's a little bit about me. I like barbecuing. I like helping folks buy homes. Check me out sometime on the page and TikTok and IG and all that jazz. Barbecue and home buying, or Clyde the Mortgage Guy. You can see some of those things there. If you like to eat good food or cook good food, yeah, please hop in.
Sounds good, man. Well, if you guys are here live, go ahead and tell us. Let us know that you're here. Give us a comment. Let's see. We got Jesse here this morning. What's up, Jesse? Hope you're having a great day too. And if you show up as Facebook user, you just got to give StreamYard permission to share your name. Otherwise, tell us your name. I'll take a peek on it as well. But anyway, if you are here live, fantastic. Be part of the conversation. Ask us questions. Share your thoughts. If you're watching on the replay, do us a favor and give us a hashtag replay. Let us know that you were here. I know that not everybody wants to make these posts live, but many of you do go back and watch them each week as we talk about what's going on with rates and the markets and housing. Especially, it's been such a crazy year, and I know that many of you do come back and check us out. So if you are on the replay, give us a hashtag replay and let us know. And remember, if you got any questions or comments, just go ahead and let us know. Let's hear them and we'll go from there. So anyway, let's do a quick recap and talk a little bit about where mortgage rates have gone over the last week. Basically, last week, overall, on average, rates went up. I'm going to say maybe about 1/8 of a point for the week. What did you find, Clyde? Did you see your rate sheets? Did you see rates get a little bit higher last week?
Last week, they definitely stepped up a little bit, and this week it seems like they have settled back down.
Yeah.
I know it. Don't want to get too excited about it, but they definitely jumped up last week, and then Friday they went down just a little bit after they had some really heavy volatility, I believe, if I remember correctly, on Friday. They jumped way up, and then they kind of settled back down and went down just a little bit, right? And then this week, there's actually been 3 days in a row. Thanks God, we'll see how it holds up. But this week it's been a positive as far as lower rates so far for the week. So hopefully that maintains for the folks out there buying houses.
Absolutely. So I'm going to show you guys a little bit of a chart and let's go over why that actually happened last week. So we talk about this almost every week. These are mortgage-backed securities. This is the foundation for mortgage rates. And as you see mortgage rates go up or down, it's based on how well these bonds are selling and what amount they're selling for. Now, these green lines that you see in an upward movement, upward does not mean higher rates. Upward means bonds are selling for more money, which actually equates to better mortgage rates, believe it or not. So when we see this movement up, like you see right here, these green lines are what we call candlesticks that keep moving higher. That's what Clyde is talking about this week, that we've seen quite a nice rebound. And that started actually last Friday, this green candlestick here. And if I teach you guys how to read the technicals, what we're looking at is the bottom of this candlestick is called the body, the fat part. The thin line that pulls away from it is called the wick. It's called the tail on the bottom. The top part here is the wick, which is where they get their name of candlestick, and the top part of the body is the fat part is still the body. So this fat part in the middle is the body, top thin part is the wick, bottom thin part is the tail. If they're red, that means we started at a higher number and ended the day lower, which is bad for your mortgage rates and pricing. If we started the day lower, like we did on Friday, and we improved on the day, it's green. So we started low and came up, and that was green. So we actually, on Friday, you can see it's a little bit of a different chart here. This is what we call a 5-day line chart. This is where those mortgage bonds are. And if we were to flip that chart upside down, that would almost be the same as what you're going to see on mortgage rates. So the bottom of this chart is when you're going to see the worst mortgage rates. And that's what we saw on Friday that Clyde's talking about. Is Friday morning, we had a really, really ugly open, which led us to a lot of lenders coming out with rates on Friday that were much worse than later in the day. And we saw what we call reprices, where the lenders will actually set new rates as the market improves. So we saw improvement, which is why this line goes up. And then Monday was a little quiet, but yesterday we saw one heck of a day. Things really improved and they held those gains, picked up a little bit more on this. When we see these improvements, we call this a bit of a rally. And when we rally, we're generally going to see rates improve a little bit. So you may want to go ahead and check any rate quotes that you got late last week or early this week. You may be surprised. They may have gotten a little bit better. And if you locked in, don't worry. You don't want to try to time the market in what we call catch a falling knife, because that can really work against you. Locking, we didn't see a huge rate difference here. Many VA loans, I think, are generally in the high sixes. Conventional conforming loans are loans that if you're not using your VA benefit, what you would just think of as a normal mortgage, that to us in our mortgage world, we call that a conventional conforming loan, that it's going to basically be below a certain amount. That would make it what we call a jumbo loan when it's much bigger. And a conventional means that it's going to go on Fannie Mae or Freddie Mac, whereas your VA loan, you're going to use your VA benefit. So VA loans generally, I think in the high sixes you're seeing, right, Clyde? For, just to give everybody a general idea.
Pretty much, yeah. Govy loans, VA, FHA, they're right there in the high sixes for the most part, depending on credit score, credit profile. Kind of to your point, though, there's not really much available outside of the high sixes. There's a little bit opened up into the sevens now. I think the highest thing we have on our rate sheet right now is actually 7 1/8. So 7.125 is there. But it doesn't seem like they're really wanting to open up too much higher than that because of the long-term risk of immediate refinances if rates just go down to 6% again, right? 6% from 7.5 or 7.75 is a huge jump. 6% from 6.75, maybe it doesn't make sense, right? So they wait a little bit longer until they get to 5.5 or 5 or whatever may occur in the future. Obviously, no guarantees on any of those things occurring, right?
Right.
So,
yes, absolutely.
Yeah, look at high sixes on Govy and then in the sevens for the most part on conventional.
So we'll give you guys a little bit of a rate forecast. Rates are improving. They're generally, we've got a bump in the road on Friday. Today is Wednesday when we record this. And the last couple of days, as Clyde pointed out, have been really good for mortgage rates and pricing. We've seen them improve. However, Friday, we've got some data on the economic calendar. Specifically, we're going to see what's called the PCE inflation data. PCE stands for personal consumption expenditures. Now, there's two inflation reports, consumer inflation reports, that come out each month. One called the CPI, which is the Consumer Price Index, and then the personal consumption expenditures report. And this one is the one that the Fed uses for their main, it's basically their favorite preferred rate for when they look at inflation. And the Fed's trying to get inflation to 2%. We've talked about this for, the last few months, inflation running at about 8%. And the Fed, in order to get inflation down, they're looking to go ahead and cut demand because they can't really affect the supply. By cutting demand, they're doing that by raising the Fed funds rate. And we have a Fed meeting next week we're going to talk about in a second. But for this week, this data that comes out on Friday, it's not likely to be very advantageous for your mortgage rates. The reason I say that is we've already gotten the other inflation report, which is for the same time frame. And it's very unlikely that you would see one report, again, for September, that said, hey, inflation was high, which is what the CPI inflation report said. And then when we get this other report, the PCE report, it's not likely that that one says, nah, it really wasn't. It was really low. It doesn't usually happen that way. So, but what could actually help us right now, it is about, let me back up a step and talk a little bit about market sentiment. So when I show you guys these screens and we show these movements that go up and down, this is basically market sentiment. And traders and investors are looking at, where do they think things are going to be and when do they think it's a good time to get in? Now, I've shown you all this report before. These are called Fed futures. Now, when we look at the Fed futures, this is where the expectations are of what the Fed is going to do to raise or lower the Fed funds rate over the next few months and into next year to see, about trying to curb inflation. when the Fed raises rates, it's going to slow down the economy. Eventually, that's going to be bad for everybody because it's going to lead to a higher unemployment. It leads to much higher interest rates. It makes things more expensive, but yet it fights inflation. How does it do that? Well, it makes borrowing money more expensive. Now, recently, we were up to a 99% belief that at the meeting next week on November 2nd, when the Fed meets, they're going to discuss raising the Fed funds rate. And they have raised the Fed funds rate since March. It's gone up consistently since March at every meeting. And it's a question of how much will it go up? How much are they going to raise that rate? The Fed funds rate right now is at 3.0. It's actually a range. It goes from 3.0 to 3.25, but we're going to call it 3.0. And it's going to go up to 3.75. And right now, when we look at Fed futures, there's about a 90% belief that the Fed is going to raise rates by 0.75 of a point, by 0.75%. There's a small percent, about 10% probability that they may only raise rates by a half a point. Now, just a week ago, this was up to 99%. There was no expectation that we would see the Fed maybe ease back. Now, for your mortgage rates, when the Fed starts to ease back on raising that Fed funds rate, it's going to help mortgage rates to improve a little bit. We're not going to see rates drop down into the fives, but we're going to see them at least stop rising, stop going up. And we've seen some really dramatic increases. So this meeting, we're expecting to see a 3/4 point rate hike, still very overwhelming, but not a near certainty like it was just a few days ago. When we look at the December meeting, this is where the expectation comes in and affects your rates today. So I've kind of shown you guys this before. The Fed is going to act tomorrow. So we're going to say Fed tomorrow. And when I say tomorrow, I don't mean the literal tomorrow. I mean tomorrow in the future. So Fed tomorrow, but rates today. And the reason that it's rates today is that markets are actually reacting to what they think is going to happen. No, it's not. Oh, that's funny. Let's try to reset that and see if it shows the way it's supposed to. Clyde and I were talking about technology right before the beginning of the call. Accept connection on the desktop app. No, I thought we did that already. Oh, there it goes. Ta-da! Okay, woke up. There we are. So when we got Fed tomorrow, rates today, if the expectation is that the Fed is going to raise rates in December and even in February, we actually see that affect your mortgage rates today. And when the expectation that the Fed will raise rates higher, that pushes mortgage rates higher. If we see the expectation that the Fed will not need to raise rates as much, that will help your mortgage rates slow down or even improve a little bit. So the expectation of December is right now that we're only going to see a half a point rate hike instead of a 3/4 point rate hike, which is what everybody thought was going to happen in December just a week ago. So we're seeing the market shift. The momentum is shifting. This is good for your mortgage rates. Again, it's not going to lead to a huge improvement. You don't want to wait weeks and weeks. And I'm going to hold off from thinking about buying a house because you're not going to see that big of a move, but we should see at least some improvement to mortgage rates as we have seen the last couple of days. And as we've seen market sentiment shift, that's why we've seen these green candlesticks here and we've seen improvement. And that's why, like Clyde said, where we've seen rates kind of improve. So Clyde, anything you want to clarify, add to that, or ask me about?
I mean, you pretty well nailed it. You dove down in there and showed why and why the sentiment is and all those good things, right? Yeah, you covered it pretty well. Yeah, hopefully.
So when people come to you now and say, "Hey, Clyde, I'm sorry,
go ahead. No, that's it. Yeah, that's it.
When people come to you and say, "Okay, Clyde, should I think about buying a house now? Is it a good time, or should I wait?" What is your thought process on that, and what do you tell them?
Goodness, it depends on everybody's situation, right? So you just have to have a conversation with whoever's looking to buy and see what their situation is. I mean, generally speaking, I think it's still a good time to buy. What I'm seeing a lot more frequently now, well, first of all, appraisals consistently are coming in above contract price. When I say consistently, like more often than not, right? So more often than not, right now, I'm seeing appraisals come in higher than the contract price, which is good, right? Can't use equity that you can't touch, but it's good to see that the values are still holding, right? So a lot of people are concerned about home values.
Right.
So seeing that, I'm actually, thankful that, right, things are staying stable and the values aren't actually going down, which is a concern of a lot of people. That's a concern if you buy a home and you have to sell it in 2 or 3 years, right? Because the values do not go up and you have to pay a realtor, right? Or whatever you need to do, right, to sell a home if you have to fix some things, whatever the case may be. then you may end up being upside down effectively on the home. That being said, it's good to see the values are still high, right? So in my personal professional opinion, again, just an opinion, right? I don't have any way to predict things, but it seems like there's going to continue to be an increase in most markets. The most recent report I heard was that they expect values to increase through 2023 at somewhere between 3 and 4% on real estate. 3 or 4% is pretty solid historically. You'd like to see more of a 5% increase, but 3 or 4% in 3 years gets you at somewhere around 10 or 12%. So if you're planning on being there for roughly 3 years or more, then probably a pretty solid idea to buy if you can, right? If the rates allow you to qualify, obviously going to depend on your market and what rents look like too, right? There's a lot of things out there. It's not just, oh yeah, great time to buy. It is a great time to buy. I mean, the best time to buy is today. The second best time was a year ago, right? And pretty much most things, right?
Yeah.
So you can realize the value. But yeah, that's my thought. I mean, it just depends on their situation. Are you going to be in this place for 3 years realistically or more? Do you have the ability to afford what you're looking at doing now? Do you have the ability to qualify? Again, values seem to be stabilized and are actually coming in higher than what contract prices I've seen recently. And I am definitely seeing sellers help with closing costs.
Yeah. We've
Okay,
talked about seller concessions in the past.
yeah,
We'll circle back on that one. For sure.
seller concessions for sure. Even to the point, they've got these buy down loans, which good, bad, or otherwise, I think they're helpful to certain people in certain situations, right? I've got 2 people, the sellers are paying for a 2-1 buy down, which means for the first couple of years, their interest rate will be lower and allow them a little more breathing room, right? They qualify at the standard rate, so they can afford, right, the standard rate, but their actual budget, they prefer to have the lower rate. So, for them, again, the seller's willing to do that. Helpful, right? Helpful in this instance to give them a little breathing room the first couple of years where they can save some money, and then, later on when the rate does go back to the market rate or whatever the rate was on the note, then they got a little bit of savings at that time, right? So hopefully rates go down in the next couple of years. We'll see though. Again, no way to guarantee that, right? But
can't guarantee it, but just like weather forecasting, that you never know. Let's say a hurricane in Florida, you can't say, hey, it's going to be right here at this time. But we've gotten better at forecasting, and what you're looking at is what are the things that affect how that hurricane goes, that affect the path of that hurricane.
Yeah.
What is the conditions of the hurricane at the time you make that forecast? Same thing for rates. And the reason, y'all, that we expect that we could see rates improve if we do a little bit of, go back to a little bit of a rate forecast. The reason that we expect to see rates improve in 2023 and maybe even a little bit later into 2023, it's basically because of recession. Recession is not something that we really want to see, but as mortgage people, we have a love-hate relationship with the recession, because a recession is generally good for home prices. It's good for mortgage rates. So it's because of those things, it tends to help our clients, which we want to see. But of course, a recession leads to higher unemployment, people struggling, and that, of course, nobody wants to see. So the idea, though, the Fed has raised rates, and what they've done, they're basically, if we have a mountain and the Fed is pushing this rock, and they're moving this rock up the mountain. And every time they raise rates, they're pushing this rock up the mountain. And that's what they're doing to slow the economy down. Well, the thing is, once they hit a certain point, it's going to go the other way. And then their job is to try to stop this rock from flying down the mountain and destroying this happy little town that's down here. And that's why they look for what they call a soft landing, because they want to push the rock over the town. They want the rock to jump over the town. But instead, generally, like a bowling ball, that rock is going to come down and it's going to go ahead and hit the village. And that's our recession. And the higher that we move this mountain, the more that the Fed, hikes rates and makes this mountaintop go higher and higher, then the worse it's going to be when we come off the other side. And that's what economists and forecasters are looking at. And the way that when we want to try to re-stimulate the economy after we've slowed it down, we're going to do that by lowering rates and by possibly taking some stimulus measures to improve the economy. We're constantly tweaking it. It's just like when you're driving down the road and you've got your foot on the gas pedal, and sometimes you're accelerating more than others. Depends on whether you're on a straightaway or a hill or etc. So that's the same thing they're doing on the economy. Based on that, there's a really good chance that we could see rates improve in 2023. At this point, if we were to have a calendar, and I'll ask you that question, Clyde, as we come towards the end of the today's time. And by the way, I'm actually going to come back to that. Let's hit a couple of questions on the comments real quick, and then I'll come back to your rate forecast. So on the comments, there was a question from Rachel that said, here's Rachel's question. She said, are these rates on a state level or are they national? So when we talk about mortgage rates, I'm using a generality. I'm giving you guys what would be a national average, if you will. And it really is just a kind of a starting point or an idea. It's not an opportunity to lend, or it's not an offer for us to lend. And that's why I'm not quoting you with an APR. And for you to get your unique situation, you want to make sure that you shop around and talk to a professional. So shopping around, we've talked about how to shop before. When you shop around, the key to shopping around is at the same time. As Clyde mentioned last week, you could have gotten a rate quote on Friday, and lender A might have given you a quote on Friday. We'll say that was Friday. But if you get a quote from lender B today, you're not really comparing apples to apples, because mortgage rates have improved between Friday and today. So you want to try to get those, if you're shopping around, you want to try to get those rate quotes around the same time. And of course, there's always more to working with a company or a professional than just the rate. You want to make sure that you're comfortable working with them and that they're, answering all your questions and that they meet your criteria. But one of the things that Chris, the founder of VA, is very big about is shopping around. And when you shop around, you're going to find national rates that are actually regional rates. These are now brought down into your level. They don't tend to change for a particular geographic region as much as they do for your personal situation. Clyde, what do you see that generally affects somebody's rate quote for, in their credit profile or in their entire loan profile? What kind of things affect a rate quote?
Sure. So there's a few different things that affect it. Credit definitely being one of them, right? The credit score. On that note, they are opening up the credit scores that can be used. I'm interested to see how that actually gets brought to the market. But they did officially allow, right, Fannie Mae and Freddie Mac to use the Vantage Score 4 and the FICO 10T, I believe.
10T, yeah.
Yeah, 10T. Yeah. So again, 300 different credit reports or something like that, or different scoring models or something out there, I think. So it may make it more confusing, but hopefully it'll help some people, right? I guess that's the main thing. Hopefully it helps some folks. I know
does race or national origin or marital status affect their credits, their interest rate?
Nope. None of those things affect your interest rate. No, none of those things do. I have seen some slight variances. The question about being regional, I have seen some slight variances where certain lenders adjust based on the state. Some lenders do make small adjustments based on the state. But things like loan size tend to be have a slight effect. Things like credit score tend to have a slight effect. Then the loan type. Typically, government loans are going to have lower interest rates, but not always. Again, government loans typically allow you to qualify with a lower credit score. So if you've got a 580 credit score or a 760 credit score, your interest rate's probably going to be different, whether you had a government loan or a conventional loan, either way, right? Again, if you're not talking about a government loan as well, the other part that could affect it is your mortgage insurance costs.
I want to clear up some jargon real quick, Clyde. Sorry to talk over you, but we use a lot of terms in the industry that we take for granted, and I know what you mean by government loan, but I want to clarify for everybody. When we talk about a government loan, what that means is it's a loan that falls under two categories. FHA and VA are the two most common categories. We also could talk about USDA, but we'll keep that away here. And the reason we call these government loans is because there's government programs that help subsidize these loans, including an FHA loan has is an insured loan. There's a mortgage insurance premium on that. But for our audience, of course, the one that has the biggest benefit, and you have to qualify for that by having served or being, the different requirements for getting a VA loan. And that allows you to get a loan with some really unique benefits, one of which is down payment. So most of the time when you get a mortgage, the down payment is going to affect the interest rate. If you put more money down, there's less risk. It can help you to get a more advantageous interest rate. For a VA loan, it's one of the few loans out there that the down payment does not affect your interest rate, because that VA loan has the guarantee and it has a zero down program if you qualify for that. And again, you would only know if you qualify for that by talking to a mortgage professional. Let them help you with your unique situation.
The other part of that is, though, right, doesn't affect your interest rate for the down payment, but there is the part on the VA loan. If you do not receive a disability benefit or you are not a Purple Heart recipient, you do have the VA funding fee, which is done to guarantee the loan right in lieu of monthly or annual mortgage insurance premiums or payments. If you do put a down payment on a VA loan, it does reduce your VA funding fee. So again, talking with your mortgage professional and seeing if that may be of benefit to you. I know in my experience, second use, which is currently at 3.6% for the funding fee, if you put a 5% down payment, it cuts that to 1.6, which is like a 40% return on your money almost instantly, right? I mean, it's in space, but man, that's a strong return. If you've got that 5%, by all means, like throw that at it if you have to pay the second use funding fee.
And if you guys are all looking at the screen going, what is Clyde talking about? That's why you talk to a guy like Clyde, because he has all that knowledge in his head, and he'll actually explain it to you until you understand it. But those are some of these different, I want to call them a trap door, that are out there on why it's so important on who you work with and that you're comfortable, that they know what they're doing. So, and if you're looking, of course, to work with somebody that has been vetted, go to vettedva.com and you will be able to find a vetted VA, hopefully real estate agent professional and mortgage professional in your area, at least one licensed in your state. Believe it or not, most people don't know, in order to originate mortgages, they have to be licensed, and they have to be licensed in each state that they originated, which is not common knowledge. People usually think, well, you can just kind of get me money, right? You're going to loan me money. It's easy. We think it's easy too, but the government, they don't think it's easy. And that's why they're here to protect you with the SAFE Act, which makes sure that everybody's licensed. So awesome. Well, Clyde, I'm going to go ahead and wrap it up. It's 12:30 Eastern time. Is there anything you'd like to leave everybody with?
Oh man, talk. If you want to buy a house, take a look at your situation and see if it makes sense. Again, a lot of people were having a challenging time with the market the way it was the last couple of years because of the bidding wars that were occurring. But again, as we talked about earlier in the conversation, earlier in the call, is it a good time to buy? Reevaluate your situation now. Instead of paying $10,000 over appraised value, you may be able to get the home with $10,000 being paid towards your closing costs and or a buy down and or something else, right? Even more. I mean, with a VA home loan, there is no cap on reasonable closing costs that can be paid. That's a big misunderstanding, that 4% is the cap on the seller concessions, 4% cap, but there's no cap on what the seller can pay on your closing costs. So they could actually pay closing costs for you. They could pay a buy down for you potentially. Again, no guarantee those things will occur, but it's definitely worth evaluating the situation as it stands right now, as opposed to how it was 6 months ago, 3 months ago, 9 months ago, 12 months ago. Get back out there and take a look at it and see if it's a fit for what you need for yourself.
Good advice. And there's pluses and minuses to buying in any market. Of course, getting a low interest rate was fantastic. The one nice thing about buying right now is all those things you said have been caused by higher interest rates. You can get your home, and when rates go down, you can most likely refinance. I can't guarantee you can refinance, and if you do choose to look to refinance, of course, there is a specialized program for VA mortgage recipients. They're called the IRRRL, the EARL. And so you could definitely check into that. But all right, well, I'm going to go ahead and wrap up. Remember, join us next week. We do this each and every week, 12 p.m. Eastern time, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. If you did go ahead and watch us on the replay, do us a favor, give us a hashtag replay. Otherwise, Clyde, thanks for joining me, my man.
Man, thanks for having me. Thanks for tuning in, everybody. And hopefully we can do it again soon. Y'all take it easy.
Right. Take care, everybody. Bye-bye.